Hello everyone, welcome to our last video of this series, which is investing versus trading. So before I start with the video, here is a disclaimer. I am not a SEBI registered advisor and the content is for educational purposes only. So the topic for today is investing versus trading. So the real difference, we will understand the mindset, the risk and reality. So what all topics we will cover today? So we will talk about investing, trading, some comparison differences and personality alignment for both. Okay. So I have seen two different kinds of people enter the market. The first one says, I want to build wealth slowly and steadily. And the second one says, I want to take advantage of price movement. So neither of them is wrong, but confusion begins when people don't understand the emotional cost of each path. So today we are not comparing which makes more money, so we are comparing which demands more from you, because both investing and trading are mental games before they are the financial ones. I hope this is very important for you to understand when I say mental games. Okay. So, what is investing? So, investing is about owning businesses and allowing time to do heavy lifting. So, it can span across years. It depends on the business growth and what is the emotional requirement that you need for this. Each is patience. If you have seen, we really talk about patience, risk reward. But for investments, patient is the most complicated emotional requirement. So I will show you a picture. From that picture, you can understand so what I mean by investing and how it will reward. So what you should have a goal for yourself. You should start doing the business analysis for this. So based on the outcome, you should buy it. You should hold it for a long period. So review them periodically and grow. It will grow and it will compound. Okay, so if you see the chart, so you can see the short term volatility, the small zigzags, and the long term direction, so which is the upward slope. So investors should always zoom out if they want to ignore the short term volatility. So you can create this simple flowchart for yourself, saying that you should have a goal. So you should understand the business analysis, how to understand the business analysis. You should learn the macros, you should learn the technical analysis, you should know the fundamentals of the company. Then you invest, then you buy more, then hold. You should review periodically and you should see it compound growing yourself. That's it. So the stock market, as I told you before, is a device for transferring money from impatient to the patient. So what all emotional reality of investing? Okay, so you might feel bored over time, because if you see daily time frame, so the market can be sideways for months and months. You might feel doubt during declines, because there are declines that definitely happens, because market doesn't go in a straight line, as I told you before. So there will be a zigzag and there will be the upward moment. So you will feel watch others climb fast profits. Some other might be invested in a different stock. They might get good profits before yours. Okay, that will also be an emotional reality of investing. So you will start questioning your patience over time. But definitely you need to be patient uh, to gain the profits. So investing tests your consistency. So it will not test your intelligence, because as I told you before, along with intelligence you should also be very patient and disciplined. Okay, if that is about investing, then what is trading? So trading is participating in a price movement. So you don't own anything here, so you should have very quick decision making mindset. So you should always think in probabilities, so no stories. Okay, so what is the time horizon that takes? It can be from minutes to weeks, and it can also go for months. And primary driver for this will be price behavior. So what is an emotional requirement that happens? So you need to be very, very disciplined under pressure. So this is very, very important. So you need to be disciplined. This is not about patience, but very, very disciplined. You might need patience here, but before patience, discipline is very, very important, because you should have that kind of a mindset. So if you see the chart, so I have given entry, stop loss, target. So before going or buying, so you should have a reason for yourself, why, what is the stop loss and reason for it. So what is the entry, reason for it, and what is the target, reason for it. So if you don't have reason for all the three things, then you are not ready for it. So this example what I have given is just for an example, and you should be watching every candle that moves. So what is a kind of an flow chart that you need to follow? As I showed in the previous slide, first main requirement for a trading is you should have capital. So if you don't have a capital, so then, so whatever you do beyond that, it's of no use. So as soon as you have capital, then you need to know like which is the best thing for you, whether it's investing or trading. So if it is a trading, then you should have a strategy for yourself. So you should learn all the basics, you should be ready, then you should build your strategy. So based on the strategy, so you should have entry, stop loss, target. So once you have all these things, and when you should know when to exit it. So that's how this pattern works. So once you follow all these things, you can repeat it on a daily time frame, 15 minutes time frame, or you can do scalp trading, positional trading. So it can be anything. So what I want to highlight here is stop loss is very, very important. So if you don't have a stop loss and market reverses very drastically, then all your capital will be gone in a single day. So you should be very, very careful while doing day trading. So amateurs might be thinking how they can make a profit, but what professionals will be thinking is how much they can lose if the market reverses. So this is very important for you, and what kind of an emotional reality hits when you are trading, right? So there can be frequent small losses every day that happens, but if your risk reward ratio is very good, those small losses will be gained in a single profit. So you should not have a self doubt after losing streaks. You might be losing for a weeks continuously, but with small losses, those small losses can be gained if you have a proper risk reward ratio. And you should not over trade. You should not have a temptation to trade more. So you shouldn't have emotional fatigue. So you need to urge, no need to urge to revenge trade. So when there are losses during the daytime, because trading is mentally exhausting. So if you don't have a structure, so it will definitely exhaust you. So this exhaustion leads to emotional requirement, which might lead to revenge your trade, which might allow you to do over trade, which will self doubt yourself when you get those losses. So that's why you should be very, very careful. So when you are a trader, and you should have all the things that I told you, so before you decide like what is the best thing to do. Okay, so what is the best thing, or what are the main comparison between investment and trading? So if you see investment, it is about ownership. So it is about long term commitment. It is low frequency, it will not involve you very much, and the amount what you have invested might be compounding over time, but patience is the key here. Okay, but what about trading? So it's not about ownership, it is about price movement that happens during the day or a week. Trading can be short term compared to investing, because in trading we don't hold it for years or months, and trading you need to be very quick. Okay, and you can execute your strategy whenever it comes in the time frame, 15 minutes, 1 hour, weekly or a monthly. So you need to be very fast in your decisions. So that can also lead to stress, and you need to be very disciplined when you do it. So that's the comparison of these two. So don't you think there will be a risk? So definitely the risk is there. So whenever you enter here, that is kind of an thing that you know by default. So what are the different kinds of a risk that happens in investing? So which is economic slowdown. So whenever there is an economic slowdown, the prices might be in a sideways for a long time, and or it can reverse. Business failures, the prices can reverse. Long recovery periods, sometimes the recovery periods might not be months but years. So what are the different types of a risk that comes in trading? Over leverage. So taking beyond your capital. So risk of slippages, emotional mistakes, or the execution error. So these are some are technical mistakes, some are mistakes that you are done that you do from your end because of the emotions. So, but in trading, the mistakes what you do compounds faster. But in investing, the mistakes might not compound if you give time. So it will be very slower compared to trading. So what all the different kinds of an emotional curve between these two? Investment, so it's less stress, it might be boredom, it might self-doubt you, but there is a relief over a period of time. But for a trading, so there is an excitement that happens. After excitement comes fears. So when it doesn't stick to that pattern, so there is a regret after fear, there is a loss of confidence, and there is a fear again, and this might repeat if you don't have proper mindset. So those are kind of an emotional curves that hits you if you are an investor or a trader. So different paths, so different emotional patterns if you see. So if you feel like you can't handle excitement, fear, or regret, so the trading is not for you. So this happens when you don't have a plan. For some, investing can be reverse of a trading and vice versa. So let's talk about the personality alignment for both. So, do you enjoy doing fundamental analysis, technical analysis, and waiting over a period of time understanding macros? Then investment might fit you. Or do you enjoy quick decision making, and do you have a structure, pattern, strategy? So then trading fits you. So investment is like an playing test cricket, but trading is like playing 2020. Some can be very good in both, but there are only very few the countable numbers who are good in their own fields. Okay. So temperament determines sustainability. Can you do both? Yes, you can do both. If that is what, if you can handle your emotional pattern, your risk. So those are two different boxes. So those are two different things. And if you want to plan to do both, then definitely have a separate rules for investment and trading, have separate accounts for both, set separate expectation for both, because mixing the two might create emotional conflict. So if I want to give an example, so there are good examples for an investor, Ramdev Agarwal. I know you have heard his name. He had a strategy of buy right and sit tight. So that's a simple line, but if you understand the context behind it, so then it's easy. So he was the co-founder of Motilal Oswal, and he is a value investor, and he has very quality growth. So, what is his philosophy? He focuses on the power of compounding. Investing for him is about owning a piece of high quality business for decades, not just a ticker symbol or a stock. So, I will just repeat this sentence: a piece of high quality business for decades. So, it's not for months or years, he's talking about decades. His investment is mainly in Eicher Motors. He identified the brand's potential early on, and he has held the stock for over 15 years. He ignores daily price fluctuations and focuses on earning growth and return on equity. So what is the kind of mindset that he has? If you see, it's quite simple: buy right, sit tight, which means he has patience. He often says that real money isn't made in buying or selling, but in waiting. So did you understand this line? So I will just repeat it for you. Money isn't made in buying or selling. What he is saying is it is in waiting. So waiting here means investing and waiting for over a long period of time. Trader, will give you an example of a trader, Nitin Kamath. If you might have heard his name as a Zerodha founder, but before that he was a systematic risk manager and he had a proper strategy to do that. So he has spent his time over a decade as a professional trader. So he represents a modern systematic trader. So what was the kind of philosophy that he had? So trading is a business of probabilities and risk management. So unlike an investor, so trader doesn't necessarily believe in the company's 10-year future. So they believe in the price action and the liquidity. He had a simple approach of utilizing technical analysis leverage and keep a strict stop loss. If a trade goes against the plan, he will exit immediately to preserve the capital. So what kind of a risk reward he had? A trader might be wrong 50% of the time, but still be profitable if they cut losses and let big win. His mindset was related to discipline. He was very disciplined with his entry, stop loss, target. For Kamath, trading is about surviving the bad days so you can utilize on the good ones. Okay, so I gave an best example as an investor and as a trader. If you have a question saying, can we do both? Yes, if you can do both. I will give us example, but as I said, so there are only few who are very good at doing both the things. The example I'm talking about, Big Bull Rakesh Jhunjhunwala. Strategy was conviction based betting. So the late Rakesh Jhunjhunwala was unique because he bridged both the worlds. He famously used trading profits to fund his long-term investments. So that kind of a mindset will be having for everyone, that they want to do profits in trading and invest that in the, and but that is not that easy, as I say. Okay, so the investor side of him was, he was a legendary bet. He had a legendary bet on Titan. So he bought it when it was a struggling watch company and held it for over 20 plus years, seeing it grow into a different jewelry giant. So that was his investing pattern. And as a trader, he was a master of short-term opportunistic trading. So during budgets or major global events, he would take massive leverage position based on the market sentiments. So he has proved that you can use high velocity capital of trading to build the foundation for a buy and hold portfolio. But this is a unique example. So this can't be the personality alignment for everyone. So you need to know so which is the best that suits you, whether it's a trading or whether it's investment. You know the emotional curve of both, so you know like what are the requirements for an investor, so what are the requirements for a trader, so what are the comparison between these two, so what are the risk differences that happens, the emotional curve, the personality alignment. So now you have an idea of both, so you can decide for yourself which is the one that suits you perfectly. So I have seen in my life investors quit because they were impatient. I have seen traders quit because they were undisciplined. So neither failed because of the market. So they failed because they chose a path that didn't fit their requirement. So you need to choose that fits to your excitement. So don't choose alignment. Choose alignment, but don't choose excitement, because excitement can be temporary. Okay, thank you. Kindly like and subscribe to this channel for more videos. So we think with this video I'll be completing the first series, which is beginners for stock market. So go next, I will be starting with an advanced version of the concept which we have already discussed. Thank you.